Hello, everyone. Welcome to Fundamentals with Matt Burk. I am your host, Matt Burk, and this educational series, as you know, is designed to help people learn about real estate funds, pooled investment funds, syndications, and all things related to raising capital from high net worth investors and funds. Today, I have a guest, Kris Benson, who is the Chief Investment Officer of Reliant Real Estate Management, which, Kris, is the 17th largest self-storage operator in the
Apparently
country.
in 2022. That number seems to fluctuate a little bit, but yeah, somewhere in that neighborhood.
So you could be in the top 10 now, is what you're telling me.
No, I'm pretty sure we're not in the top 10. That'd have to be a big jump.
Yeah, anyway, Kris and I met in person here a few months back at the Best Ever conference in Salt Lake. Kris presented in the Very Best Pitch Slam. And Kris, I appreciate you doing that, and really actually liked your vehicle, and we got to know each other a little bit. So Kris agreed to come on the show. So thank you for being here. I appreciate it.
Yeah, my pleasure. Happy to do it.
So tell us a little bit about Reliant. Tell us about your funds. I know that you guys have run a number of funds, and I'm going to dig a little deeper into what you like and don't like about fund management. So that's kind of the focus of the show. But why don't you give us a little background on yourself and on Reliant?
Yeah. So Reliant is a vertically integrated self-storage operator, which just means that we're buying and managing the properties that we're buying. Matt, I'm talking to you from our office in Roswell, Georgia. We're just north of Atlanta, about 20 miles. And to your point, we're the, let's say, top 20 self-storage operator in the U.S. We have 88 properties across 8 states, mostly here in the Southeast. That's where we focus most of our time, energy, and effort. And, historically, we've raised capital, I want to say pretty much every way there is to raise capital. We have an institutional partner in Harrison Street Capital out of Chicago, mid-market private equity firm. We have a really large family office that's been a partner of ours for many years. And then we've built our own retail network, Matt, not too dissimilar than, what you guys have done with Fairway. And we're on our 4th fund. We used to do individual syndications, and we did those up until 2019. And then in 2019, we launched our first fund. And we've basically done a fund a year since then. We just launched Fund 4 at the end of 22 and targeted to be a $100 million equity raise. And we're just over a third of the way through that, 4 properties in it, another 3 under contract. So we're just starting to get that rolling.
So it sounds like you guys started off like a lot of people do, is doing individual deals, syndicating them, and then over time you kind of gravitated toward a fund model. Walk us through like what was going through your mind then. How long did you guys think about doing a fund before you pulled the trigger? What were some of the thoughts, fears, thinking behind doing a fund when you first did that back in 2019?
Well, to answer your first question of what we were thinking, fear was what we were thinking. Look, with individual syndications, the risk-adjusted return there is not very good. So as investors in the retail side of things, what we thought about is, our average equity check from our retail money is just over $140,000. And so our deal minimums are typically $50,000. So, if you're an investor with us, you may be in 1 or 2 of our deals, and that doesn't provide much on the protection side of things as far as diversification is concerned. So the fund just gave us a tool to be able to offer to our retail investors a well-diversified offering where, our first fund, Matt, was targeted $50 million raise, which we were successful in raising. And we had 11 properties across 4 states, right? So just like a mutual fund in the equities market, our investors felt like, okay, this is a good balance of, diversification across multiple markets, multiple business plans, multiple properties. And we felt like from a risk-adjusted standpoint, it really put us in a position where, if one property got hurt with oversupply or something happened in the market, our investors, had the rest of the portfolio to buoy the performance. And our investors have, I think, gotten comfortable with that as well. There's still some people who still think, hey, I'd like individual deals, but the fund model for us has been good, both on the administration side. I think there's some efficiencies we've created there. But, I think from a safety piece for protection of principal, it's a much better way to approach it if you're a passive, a high net worth accredited investor looking for passive opportunities.
So did you do it more? I mean, what I gather from that is that you did it as a result of investor inquiries wanting more diversity, or you did it more because my experience, Kris, is with a lot of managers, right, is like there's a lot of inefficiencies in raising capital one deal at a time, right? You have to put together all the material for one deal at a time. You have to, you're under time pressure, if they close by a certain date, you're not 100% sure you can raise the money, where it's going to come from. Deal terms change at the 11th hour that you then have to redisclose to investors. There's a lot of reasons that make it hard. So did you do it more because of efficiencies for you guys as operators, or more because your investors were demanding a vehicle that was more diversified than having exposure to one-off deals?
Yeah, it's a fair question. I would say more so it was us and trying to provide that to investors versus them demanding it. They were pretty comfortable with the model we had rolled out, right? Individual syndications, a deal comes out, they choose to invest, yes or no. And we've had a pretty strong track record. So, I think people are just used to what they're used to.
Exactly.
I would argue when we launched the fund, there was actually quite a bit of pushback from those investors saying, hey, I want to choose the property. And this is what I always say, Matt, is
that was my experience when I first did it years and years ago. Same thing.
Yep. And what I always say to people is, well, how many self-storage properties have you bought? And the answer usually is 0 or not very many. So the question I always ask is, well, then why do you want to pick? Don't you want us to choose the portfolio that we think is going to provide the best opportunity for returns? But I think it's people getting comfortable with something different. They want to understand that, it's not just blind pool. We're going out and buying all kinds of stuff, that they understand what the strategy is of the fund. And for the most part, I think people reacted appropriate once they understood and had the education. Now, the secondary benefit was what you just described is it's 1 PPM for, let's say, a year, right? You got one set of subscription documents, one set of terms. Generally, it's a pretty broad definition of what we can go and do. And I would say, Matt, we've definitely learned from Fund 1 to Fund 4, we're constantly tweaking little things along the way to ensure it does what we want it to do and what's best for our investors.
Yeah, I would say I find invariably, and this has been true with my own experience and also many clients that we've advised over the years, is that there are a lot of things that you do that have downstream consequences that you don't fully appreciate when you first do them until you're actually in the boat. And then all of a sudden you realize, oh, hey, I did this thing and look what it's doing. And it causes investors to respond in a certain way. And then you need to, work out from under that, maybe in that deal or in the next fund. Any examples of that? Has that been your experience?
Yeah, for sure. The one thing that we did not consider in Fund 1 and Fund 2, it took us till Fund 3 to figure it out, was the difference between an American and European waterfall, and what disincentives that can create between an investor and us as a sponsor. And for those not familiar, essentially think of it this way: with a European waterfall, all of the capital for the entire fund has to be returned. So if it's $50 million equity raise, we have to return all of the $50 million, then catch up all of the pref, and then we go to a waterfall split. In an American style waterfall, it's deal by deal. So, if the fund has 10 deals in it or 20 or 30, you're essentially creating a waterfall for each individual property. And in our world, what it prohibited us from doing was, if there was a specific deal that we wanted to sell in Fund 1 or Fund 2, Reliant doesn't participate in the upside of that deal, right? If we have to return $50 million in principal, generally we're going to have to sell a big chunk of that portfolio before Reliant gets into the profit split. And so what you want as an investor is us and the investor to be aligned so that we both benefit at the same time. And so, learnings like that, Matt, to your point, we didn't think about it until we went to exit. We had an offer on 3 of the deals in Fund 1, and we were like, oh, Reliant doesn't benefit from those at all. Now the investors do, but what we ended up doing, we've actually gone full cycle with Fund 1, and we traded the entire portfolio. There were 11 properties in that portfolio. So, little nuancy things like that, like you said, until you're in it, and you figure it out, you're not going to know. It's just a function of, hopefully you have good counsel along the way who bring up these things to you. And this is where I would say the legal team that helps you put these together is critical. They need to have a lot of experience in the fund arena with other clients, because they can tell you where the sharks are in the water.
Yeah, and I find that legal is vital, right? You have to have lawyers, and they need to be able to sign off on the validity of the securities documents and so forth. I find that they aren't necessarily looking at it from the fund manager's perspective. They come at it largely from the legal angle. But when you're in the center of the wheel, right, and all the spokes, one of the spokes is legal, but it's not the only spoke, right? There's accounting, there's admin, there's origination, there's asset management, there's capital raising, there's investor relations. They all intertwine together. And so looking at it from a holistic perspective is part of the challenges. As you guys have done this, and now you're on your fourth fund, what would you say is the biggest learning you've had from the beginning to now that you might give to aspiring fund managers in the future?
I would say, and you touched on it, Matt, is start small, make the first fund executable, right? Ensure, one, that you can fill it, and two, that you can get through it quickly so you can take those learnings to move on to the next one. And look, the smaller the fund, the more nimble you can be in the marketplace. Let me give you an example. So Fund 4, we increased our pref and essentially reduced our IRR hurdle for investors because of the market we're in. We believe there's going to be less upfront cash flows as interest rates are higher. So what we're saying to investors is, look, we'll take more risk on the back end. We'll give up more on the front to you, the investor, because cash flows we're in an environment where cash flows will most likely be less. And so, I think when you have a large fund that maybe you're raising over a period of 2 years, the market shifts and you can't really change the rules in your fund. So if you start small, and that's a relative term depending on the group, but let's say you start with a $10 million fund, $25 million fund, depending on the asset class you're in, it allows you to kind of work out the kinks and get it finished and say, okay, now what? What's the market say? What are we trying to do? Has our strategy changed? Let's adjust the docs or the fund based on those experiences.
Yeah, no, I think that's good advice. So let's pivot a little bit to what are you guys seeing out in the market right now? Obviously, lots of turbulence with high interest rates, and looks like they're probably going to go up again here tomorrow. Hopefully by not too much, but what are you seeing out there? Are you seeing opportunities? Is the storage market still holding up pretty good?
Yeah, we just had a meeting with our operations and asset management team this morning. But for those people not that familiar with self-storage, it's a very seasonal business. So typically, you have a peak season through the spring and summer and a slowdown through the fall and winter, generally. 2021 and the first half of 2022 were anomalies where we had no seasonality. It was just great all the time. And I think we have seen the reversion back to that seasonality in Q4. And even in Q1, what we don't know yet, Matt, is kind of year over year, are we going to get that pop back in the spring and summer? And I think all of us in the industry are waiting to see what happens this summer. One specific thing that I can speak to is our AR. So accounts receivable, the amount of money we are not receiving from tenants. Tenants are paying late more often or not paying at all. So the number of auctions we're doing is much higher quarter over quarter versus Q1 of 2022. So what that means to me is, the economics in the market are shifting and people have, less disposable dollars to pay. I think that's what we're seeing on the consumer side. From a deal level, there's still deals out there to be had for sure. Interest rates are higher, so cash flows are less, but we're seeing pretty good basis, or deals that we're going in at pretty good basis comparatively what we've seen for the last 2 years. So, time will tell.
Have you actually seen some downward pressure on price generally with the higher interest rates, or not a lot?
I would say not maybe to some extent that other asset classes have experienced. I have a bunch of buddies, and Matt, I know you guys have a bunch of stuff in multifamily. We've seen a pretty good correction there. I think it's arguable by market, but some guys have said kind of 15 to 20%, maybe even more. I would argue it depends on the market for us. I think a lot of sellers who don't have to sell are just waiting, and they're just going to see what happens. But, with this seasonality, or with this push, this pressure on, let's call it rates, or, if basically in storage, if occupancy starts to dip, generally people are lowering rates to try to boost occupancy. Well, if you're in a situation where occupancy is starting to dip and you have to lower rates, there are sellers that are saying, well, maybe I can't get my NOI back up where I need it to be. I better trade this thing now. And so I would not say we're seeing any type of distress, but there are some sellers entering the market who are motivated to do it. My personal opinion is there is less downward pressure on pricing than I've seen in other asset classes in self-storage, because historically it's performed well in a recession, and I think people are still, buying into that.
Yeah, I was just going to say storage is a pretty well-renowned asset class that is to be resistant, let's say, not immune, but resistant to downward macroeconomic pressures. Are you finding that it's holding up, and living up to its historical reputation during this downturn?
Are we in the downturn right now?
Well, I guess it depends on what you characterize as a downturn. I don't think we're technically in a recession, but certainly the increase in interest rates, for all intents and purposes, anybody in the real estate space certainly feels like it's a downturn.
Yeah, I'll tell you in 6 months, right? I don't know yet what happens. The AR and kind of the late fee thing for us is an interesting kind of canary in the coal mine, right? Yeah. As a leading indicator of, okay, those are real numbers that's not our operations, or that's not market specific. That's at the portfolio level. So I think time will tell there, Matt. It's hard for me to imagine when I think about real estate asset classes, I think about how does the demand change. Office is a great example right now, right? At a macro level, office is shifting. The world is changing as far as how people consume that asset class. I'm sure you saw in the Wall Street Journal that building in San Francisco that traded at 20% of its value last week from 3 years ago.
Yeah, it went from 300 million to like 60 million.
Yeah, that's tough trucking. So I don't think the consumer demand has shifted in storage, but time will tell. I mean, if people are struggling to put food on the table, are they going to pay their self-storage bill? Probably not. So I think it depends on how deep and how long the recession goes. But if I had to bet, I would guess that 2023 is probably not a great year for rental rate growth in the self-storage industry.
Yeah, it seems pretty resilient though, and that's one of the other things people like about storage, right? Is you can mark those things to market much quicker than you can many other asset types. So they bounce back pretty good. And one thing I've also noticed about storage is a lot of times, especially when the market is good, you'll get buyers that'll pay you both cap rates based on stabilized, even if you're not there, because they think they can go in and raise those rents, really quickly. So it behaves a little differently than a lot of other asset classes that are a little more traditional than storage, which makes it interesting.
Yeah, for sure. The 30-day lease is a big advantage, right? You can be really nimble in the marketplace as far as pricing is concerned. And, to your point on the seller side, if you're selling to institutional capital or one of the publicly traded REITs, they always believe that they have efficiencies of scale. I mean, they believe they can buy one of our sites and add NOI just by plugging in their platform. So, there's huge value there for sure.
Yeah. How about on the investor side? What's your experience with respect to raising capital in the fund right now, given everything that's going on? Is that more difficult? Like, to what degree? What are you seeing out there on the capital raise side?
Yeah, year over year, Q4 and Q1 were definitely slower than what we've seen historically. I think people are scared, or scared is probably too strong a word. I think people are cautious as far as what they're deploying capital into, and when is the right time to do it. my opinion is timing the market is a fool's errand. When people say like, is now the right time to buy self-storage? I don't know. I mean, maybe, but if you had asked me in May of 2020, should we be buying self-storage? I would have said no. Fortunately, my partner said yes, and we bought a ton. And all of those deals through COVID, we've crushed it, right? But I don't really know. I mean, I think you underwrite conservatively and try to put yourself in a position, regardless of market conditions, you're going to be okay to ride through some of these ups and downs. And I think investors, I would say Q1 for us and coming into Q2 here in May, we're starting to see a little bit of loosening where investors are coming back to us saying, yeah, okay, I'm good now. Like maybe the world's not going to fall apart. So I think the capital raise is improving, but Q4 and Q1 were definitely slow. Have you guys seen similar trends on your platform?
Oh yeah, it's much more difficult. I'd say deal volume, finding deals that pencil is much harder, just generally speaking, across most asset classes, right? Interest rates are considerably higher. Investors are more cautious and more nervous. A lot of them that invested heavily in 20, 21, 22 have cash tied up that they don't until some of that stuff recycles unless they've got new cash coming in. It's just harder generally. It's a more difficult environment, but things always go in cycles, right? It's not dissimilar to what I saw during the Great Recession. It's a different reason why all this stuff is happening, but it's similar kind of mindset. But coming out the other side, as generally speaking, I think there's a lot of money piling up that is earmarked for real estate that is coming back in at a certain point, and the pendulum will swing. It's just a question of when.
Yeah, that's the piece. I'd be curious for your feedback on this, and for the people listening, maybe throw it in the comments. I'm not sure how LinkedIn Live works, but there's a boatload of dry powder or rescue capital or institutional money is waiting, right? They're making a decision that they think they can come in and be rescue capital, and they may be able to, but there's a lot of it, hundreds of billions of dollars that's sitting on the sidelines, and so. What I think about is unless there's kind of catastrophic blood in the streets, all that capital has to be deployed.
Exactly.
It's got to go out the door. And if there isn't this huge swath of pain, right, or defaults and people turning properties over, then what does that capital go back into? And I think the answer is it gets deployed in real estate and maybe shifted a little bit, away from office, right? But all the other, multifamily and storage and industrial and retail, I think that money's got to go out the door. So the question I always have is, will it cushion the pain? If there is some pain, does all of it get gobbled up so quick that it kind of is a blip on the radar? I don't know the answer.
I don't either, but it's a super interesting question. I listen to Peter Linneman quite a bit and follow a lot of what he talks about, and he says a lot of the same things, right? It's like there's just a massive amount of money that's been assembled to come back into real estate, and like how long are they going to wait? They got to get the money back out. I think once you see some stabilization in the rate increases, which may come after this next one, I think you'll see people getting itchy trigger finger and got to get back in regardless, and that might make the depths of the pain not as bad for some people if they can hang on long enough, right? So it's almost it's a game of wills, right? Who holds out longer? Sellers or people that have money, they got to get out the door. To your point, I don't know. It'll be interesting to see.
Yeah, the one thing I will say, thinking back to kind of the GFC side of things, is it took a while for this to all kind of shake through the system. And my question is, with the retail banking, SVBs and First Republics, is this the tip of the spear? And do 6 months from now look a lot different? That's the part I don't, I have no sense of. Smarter people than you and I hopefully are looking at this and trying to make sure that it doesn't happen. But I could see, just hypothetically, we talked about that building in San Francisco, right? There's a bank behind that, and that bank's going to get crushed. And so if you have these pressures on office where a whole bunch of banks are in trouble and defaulting loans, and you kind of have this retail pressure from consumers who have fear on the banking system, that could get messy. And, we were talking about it last night with my CFO, and our accounting firm was in the office, and she's like, what do you do? And I was like, nothing. Like, what do you want us to do? If banks start calling loans and we're all going to just do our best, one foot in front of the other. You can't stockpile $500 million in cash and hope that we can protect ourselves. But it's that could be interesting.
Yeah, well, it's never a dull moment in this life now, is there, man? It's always something new and interesting to deal with. But as you pointed out, man, I think a lot of it is just when you get into times like this, it's a little bit of battle mode where you just, you put out one fire at a time, and you focus on the biggest one, and you let others burn for a little bit if they're only a brush fire, and you just go do it every day until at some point pendulum starts to swing. So, all right, man, we're getting to the bottom of the hour and running out of time. So I'll ask you a couple of quick lightning round questions. But what's one energizing book, audio book? What do you like? What are you reading or listening to these days that gets you excited in terms of the learning that you're doing?
Yeah, so I try to do the book that I love the most. I try to gift. That's how I think about my favorite books. So 2022, have you ever read Die with Zero by Bill Perkins?
I've heard of it, haven't read it, but I will absolutely add it to my list.
Yeah, put that on the list. My 2023 book, I think, is going to be Who, Not How. Have you read that? Dan Sullivan?
No, I know Dan Sullivan. He's the strategic coach, right?
Yeah.
Yeah. No, Who, Not How. I'll mark that one down.
So from an entrepreneurial standpoint, if there are people on the call or watching this recording, it was one of those mindset shifts for me that when I read Rich Dad Poor Dad, I read Rich Dad Poor Dad, I was like, oh, passive income, that makes a ton of sense. And this entrepreneurial, basically the thesis is, at least I function this way. When you have a problem or something you want to do, the first thing I think about is how do I do that? And the whole thesis is, no, there's already somebody who knows how to do it, and they can do it much better than you can. So just go get the who and forget the how. And for me, I read it and I was like, well, there's certainly a lot of things I've been trying to how for quite some time, and I just need to go hire the right who.
Yeah. Well, that's good. I'll mark that one down and check it out. What's the best way for people to get a hold of you, Kris, if they want to reach out and learn more about Reliant or you?
Well, we're on LinkedIn. You can certainly reach out that way on our LinkedIn profile, or my LinkedIn profile. It's Kris with a K, obviously, as the spelling is shown. Our website is reliant-mgmt.com, so the abbreviation of management. Certainly go out there. There's a whole bunch of ways to contact us, buttons on the website, and our team will get in touch if you have interest. And then if you live in the greater Atlanta area and want to come visit us, we do a fair amount of in-person events. We're actually doing one this evening. So we always love to meet people in person if we can as well.
Glad we're out of COVID and able to do that again.
Yeah, for sure.
All right, Kris. Hey, thanks for being on the show, man. Appreciate it. Always good chatting with you, and I'm sure we'll be in touch.
Sounds good. Thanks, Matt. Have a great day.
All right, thanks everybody. We'll see you here back next week for episode 12. Meantime, stay sharp.